Hello friends, how are you all doing? Today's session, we will be introducing you to the financial statements of a not-for-profit organization, which is Income and Expenditure Account. In an earlier video, I had introduced you to the financial statement, receipt and payment account. In that video, we learned about its features, its contents, what it contains, and also how it is prepared. In today's video, I'll be introducing you to Income and Expenditure Account. We'll be learning the format in which it is prepared, what are the contents that go into the Income and Expenditure Account, and the features of the Income and Expenditure Account. The topic shall be split into multiple sessions as there are multiple items which require detailed understanding. So if you have not yet subscribed, please do subscribe and get continued notification of the upcoming sessions. Okay, so now let us begin with our today's session. First, as introduction, if you have already watched the video of receipt and payment account, you would know by now what is not-for-profit organization. Now, for those who have not yet watched it, please do watch it. But what do you mean by not-for-profit organization? Now, business organizations can be classified into two categories. Those which are having motive of earning profit and those which do not have profit as their motive. Not-for-profit organization falls in the second category where their intention is not to earn profit. So what is the intention of such organizations? Not-for-profit organization in short form called as NPO, the objective is to render service. So rendering service is the motive of an NPO. So it might be rendering service to its members or it might be to public at large. So what type of organizations can you expect to find under this type of organization? Like you have charitable hospitals. These hospitals render service not only to specific people but to public at large. You can have sports club which might be registered as an NPO where they render service to the members who take membership into their club. They can avail the service of the club. So these are certain examples of not-for-profit organization. The type of financial statements which are maintained by business organization varies on whether it is a profit earning organization with the motive of earning profit or not-for-profit organization. When it is a normal business organization with a motive is profit, you would know that you would be preparing the normal profit and loss account and balance sheet. But not-for-profit organization, the financial statements prepared are a little different. The financial statements that are prepared by a not-for-profit organizations include 1. The receipt and payment account. From the term, we understand that all the receipts and the payments are going to be recorded in this account. It is nothing but summarized cash book. You can see for detailed understanding, please do watch the video which is where there's a detailed discussion of the receipt and payment account of what it contains, how it is prepared. The second financial statement that we'll be discussing today's session, that is income and expenditure account. This is very similar to your profit and loss account, but there is a variation in the sense that this is being prepared by an NPO or a not-for-profit organization where the intention is not to earn profit but to render service. So that is how it is not to determine the profit earned or the loss incurred by the business but to find out the surplus, that is when the income exceeds the expenditure or whether there is a deficit, that is where the expenditures exceed the income. So the ultimate aim of preparing this income and expenditure account is to ascertain the surplus or deficit of the not-for-profit organization for that year. Now, other than that, the third thing would be the balance sheet, which is prepared on the same principle as a business organization. Only the items that you would find would be a little different. Here you would be having certain fund balances which are being maintained by the not-for-profit organization. Today's discussion will be restricting to the understanding of the financial statement, income and expenditure account. Now, income and expenditure account. What do you mean by that? It's an account. So we prepare it in this format. So first let us look at the format. It is prepared in the form of account. So there should be a debit and credit on either side. There is a debit side, which is the expenditure side. And there's a credit side, which is the income side. The debit side shows all the expenditures which have been incurred during the year. Whereas the credit side, you would have all the income earned during the year. The expenses and the losses come on the debit side, whereas the income and the gains made during the year, current year, would come on the credit side of the income and expenditure account. Now, going into the details of the items that you could find, first we will understand the items that we could find on the expenditure side. First, you could have several expenses of routine nature which are incurred. Like you can have salary, you can have rent, you can have other expenses like telephone expense and so on. So all these routine expenditures, printing and stationery. So there are several such expenses. So each one of those items individually are debited here on the expenditure side. There are going to be adjustments which I'll be discussing in detail. Next, you could find items like the insurance premium which is paid during the year, which is related to the current year. You can have items of non-cash expense like depreciation on the fixed assets which are owned by the not-for-profit organization. So that comes into the debit side. There could be items like loss on sale of fixed assets or investments. So those losses, that is excess of the book value over the sale value, would come as a loss on the debit side. That is why I said expenditure side includes the expenses and the losses. If it's a sports club, you could have items like sports material consumed during the year. If it is a hospital type of organization, you could have medicines consumed during the year. So basically, on the basis of the type of activity carried on, you will have additional items which you could find here. But basically, all these items, when you look at, you will know that these are in the nature of revenue expenditure. So in the receipt and payment account, we record all the receipts and all the expenses which have been received or paid. So expenditures paid during the year come in the receipt and payment. Out of that, we are going to segregate those which are of revenue in nature comes into the income and expenditure account. So basically, items of revenue in nature are put on the debit side of the income and expenditure account. Revenue expenditures are those expenditures which give the benefit during that accounting year. Like the salary paid, rent paid, helps you to get the services of the employees during that year. Rent you pay, you are able to use the premises. Telephone expenses for the telephone service that you have used. Insurance premium you have paid is for the period of that accounting year for which you have paid. Depreciation is on the asset. Reduction the value of the asset which you have used during that year. Sports material or the medicine consumed is whatever has been used during the year. So basically all the items of revenue nature comes on the debit side of the income and expenditure account. Similarly, on the credit side, it is also the revenue type of items that is related to the income of the year through its normal operating activity, whatever is being generated, that comes on the credit side. Here you can have various types of items like subscriptions. Subscriptions are the amounts which are received by a not-for-profit organization from its member on a routine basis. It might be collected either on monthly basis, quarterly basis, half-yearly basis, or yearly basis. That doesn't matter. But it is going to be collected every year on some regular basis. It is the source of fund with which the NPO operates and renders service. So that is a very important item. It is a very vast topic which would require a detailed understanding. Further details, I'll be uploading further videos which will be discussing detail about these items. Other than that, you might have items like the donations which are received. Basically, donations further is a vast topic where you will have donations which are general donations which are received, where there is no conditions imposed, which can be used by the not-for-profit organization for any purpose that they wish for. So it can be used to pay up their routine expenses like these. Or there can be specific donations which are donated by the donor by specifying the condition for which it has to be utilized. Like donation might be given towards building fund. So it has to be kept in separate building fund and utilized for the purpose of construction of building. It can be for sports fund. It can be for tournament fund. It can be for such specific funds. So it has to be set aside and used only for those purposes. It cannot be used for such routine expenditures. So the donation that you find in the income and expenditure account is normally the general donation where the donor has not imposed. Donor means a person who has donated to the not-for-profit organization. There he has not imposed any restriction on the use and has just donated for the purpose of to be used by the NPO. Other than that, you can have items like the entrance fee or the admission fee which might be collected by the NPO. These are also available freely to be used for the normal purpose. Then there is legacy donation which is received. This also when there is no specific condition given, when it is of general nature, it can be utilized for meeting the routine expenditure. If it is specific donation, it will not come in the income and expenditure account. It will go in the balance sheet. Other than that, you can have certain items like sale of old newspapers, like you have here loss on sale of fixed asset. If you have sold some fixed asset and you have gain, then those gains would be credited to the income and expenditure account. So like this, you might find several other items, like you might have other sundry receipts which might take place, which are of revenue nature, which would come on the credit side. Basically, you can understand that it's an account. This does not have opening or closing balance like your receipt and payment. You close the income and expenditure account, and when you close it, you're going to find out which side total is more. If your income side total is more than the expenditure, then you're left with surplus. So you put it on the debit side as to surplus excess of income over expenditure. And if your expense side total is more, then you have spent more than what you have actually generated. So that shows a deficit. So you write it as excess of expenditure over income. So this is how you prepare the income and expenditure account. Now, what type of account is the income and expenditure account? From these items and from the term income and expenditure only you can find out whether it's a real account, personal account or nominal account. It has expenditures and it has the income. So from this only you can understand and retain and remember that it is a nominal account where you are showing the income and expenditures. Now further, the important point here is that these items that we are writing on the expenditure side or the income side, whatever is item we are writing it is the expenditure related to the current year. So now we are going to be preparing income and expenditure account with the help of receipt and payment account. But in the receipt and payment account, it is the receipt and the paid which is being recorded. So you have the total expenditure paid during the year. But that paid amount might be related to current year, previous year or next year. Everything is put together. What is paid is put there. But when we are taking it into the income and expenditure account, we are supposed to match the income and the expenditure of the current year. We are following the accrual basis of accounting. We are following the matching principle. So when we are following the matching principle and accrual basis of accounting, we have to record the current year figures. So we will be adjusting the amount from the receipt and payment, like salary paid during the year, would be adjusted for the outstandings, prepaids, etc. Like, for example, you have salary paid in the receipt and payment account. You'll be adjusting it for the outstanding at the beginning, outstanding at the end. So whatever is the outstanding at the end refers to the expenditure which is the expense of the current year, but it has not been paid. That is why it is still outstanding. So it should be included. So we add the outstanding at the end of current year. Whereas whatever was outstanding at the beginning of the year is related to the previous year. Previous year it was outstanding. That is why it has come as opening outstanding. So it is related to previous year. It would have been paid during the current year. So in the paid amount that would be included. So we'll have to remove that. So we subtract the outstanding at the end, at the beginning of the year, of the current year, from the paid amount to arrive at the expense of the current year. So we start with the paid amount and we adjust it for the outstanding at the end by including it and subtracting whatever was outstanding at the beginning to arrive at the current year expense. Similarly, sometimes prepaid insurance, you can find that you have paid insurance in advance. Then under such circumstance, we would be subtracting the prepaid. Whatever has been paid in advance related to next year would be subtracted. So prepaid at the end of current year would be subtracted, whereas whatever was prepaid in the beginning was prepaid in the previous year but relates to current year. So that has to be included because it is related to the current year but got paid the previous year. So prepaid at the beginning of current year. So this way you start with whatever has been paid, you adjust it for the prepaid and get the current year insurance premium. There's a depreciation which is a non-cash expense which would not be seen anywhere in the receipt and payment account, which is an adjustment which you'll have to calculate on the basis of the value of the asset and the percentage of depreciation applied and put it here. Then further, the sports material consumed, medicine consumed, printing and stationery consumed have to be computed by taking into consideration the opening stock of these materials, the purchases made during the year and the closing stock of material. So using those concepts, you would be finding out the material consumed. So opening stock plus purchases minus closing stock would give you the material consumed, and that would be the amount which you will be putting as a current year consumed amount. So like this, you will be having number of adjustments which you do not find in receipt and payment account. you will have to adjust so that you get the expenses related to current year. Similarly, for income as well, like for the subscription, there might be some of the members might not have paid for the current year completely. Then that has to be included, because although it has not been received by the NPO, it is income. So we would be adding to whatever has been received the outstanding subscription at the end of the year, because it is the current year's income. But whatever was outstanding at the beginning would be subtracted, because it was the income of the previous year. It might be received now because it was not received then, and therefore that has to be subtracted. Similarly, you might have received some subscription advance, so all those have to be adjusted. So you would have advance at the beginning, which would be added of the current year, and advance at the end of the current year, which would be subtracted, so that you get ultimately the current year income, subscription related to the current year. Now, by following this, you are adhering to what is called as matching principle. You are following accrual basis of accounting in the preparation of the income and expenditure account. So this is how income and expenditure account shall be prepared. And finally, the main intention is to find out the surplus or the deficit, which has been the surplus, whether there has been a surplus during that particular year or whether there has been deficit. This would get added, surplus would get added to the capital fund, whereas the deficit would be subtracted from the capital fund. So this is the receipt and payment account which will be prepared. In further sessions, I will be discussing in detail about the individual items so that we understand the proper preparation of the income and expenditure account. To summarize, let us understand. I told you income and expenditure account is the nominal account. Why? Because it deals with income and expenditures. It is very similar to profit and loss account, but because on the debit side you have the expenditures, on the credit side you have the income, but here the intention is not to ascertain the profit or loss but to ascertain the surplus or deficit. The debit side has all the expenditures, so expenses and losses are debited, and on the credit side you would have the incomes and the gains related to the NPO. Then what is the type of items that you could find? All those items of revenue nature which you can find in the receipt and payment goes into the income and expenditure account. So what about those items of capital nature? Those related to capital nature go into the balance sheet. The basis of accounting that we are following when we are preparing income and expenditure account is called as accrual basis. We are not following cash basis. When you are preparing a receipt and payment account, we are following cash basis. In the preparation of income and expenditure account, it is accrual basis of accounting which is prepared. We follow the matching principle. We match the expenses with the revenue. And we find that there are several adjustments related to outstanding expenses, prepaid expenses, depreciations in non-cash, advance income received, advance accrued income. All those adjustments you can find in the income and expenditure account. We make those adjustments and arrive at the current year figures. All these adjustments are done so that you find what is the current year income or the current year expenditures. So they only come into the income and expenditure account. This account does not have opening or closing balance like your receipt and payment account where you had cash and bank balance as opening and closing. Here you close it by finding out the surplus or the deficit which gets transferred to the capital fund. And as you can see, the main intention here is to put the items related to the current year only. So this is about the income and expenditure account. So with that, we come to the end of today's session. Hope it was helpful to you. If you need any clarification about this, Please feel free to leave your query in the comment section below. I'll be glad to resolve them. Thank you all for joining me today. Stay tuned for more session on the subtopics in the preparation of income and expenditure account, where I'll be discussing in detail about the items related to the adjustments, related to your expenses, your subscription, your materials consumed and so on. So please do like, share and subscribe to the channel. If you like today's video, please do like and subscribe to the channels. Thank you. Have a great day.